Oh, make the bad man go away. Put him back in the can. Put her back in the bottle. You know, we've always talked about, well, you've read about, you kind of forget about inflation. You kind of forget about the Fed with their 15 bumps from 2004 through 6. When that inflation gets out of the bottle, real tough to put it back in. Matt McAleer, June 10th, ugly week, uglier day. Here with Shaun Burgess, we're going to do a quick review of the fixed income and equity markets and see what we can do to try to get through some of this pressure. Shaun, what'd you see today?
It was an ugly day, just like in equities. Bonds really took it on the chin. We had an inflation print that came in higher than survey. I think it disappointed a lot of people who were looking for some real moderation in that number. Instead, we get a 1% month-over-month number and an 8.6 year-over-year number. So not the numbers you wanted to see if you're really looking for some moderation in inflation and it kind of come back and give the Fed some breathing room. Not a great number. Bonds sold off. Treasuries really took it on the chin. Not what you wanted to see in the fixed income space, but you really need to see more numbers to see if we can get inflation. If it's gotten past that peak, that'll really give the Fed some breathing room to start getting into a less hawkish tone.
Yeah, and everything is so day by day in today's world. Mm-hmm. The reality is a 50 basis point bump takes some time to work into the economy, right? Yeah. The last bump. We'll see another one. Now you hear maybe 75's needed. Who knows? But those bumps take time. You can already start to see them working in some of the core areas, but not the two biggies, which are food and energy. That's really driving what we're seeing day to day. We've seen some softness creep into some of the retail markets, some of the automobile markets. We've seen some softness start to come in, which is what the Fed wants to see. But we have headaches in food and we have headaches in energy. And that energy piece, as we've said, is a hard one to solve because there's very few switches that can just be flicked. What about in terms of Munis? How did Munis act versus Treasuries today?
It was definitely a quieter day. We had that nice rebound last week coming off of some of those valuations we were talking about with Munis really oversold. This week, the market took a step back, a little bit of a breather, saw a little bit more outflows, saw some outflows off that good inflow number last week.
Yeah.
So I think, like the equity markets, bond investors are really looking to see what inflation does, what the Fed does to really get some conviction to put money back to work. And that's what we're going to look to take advantage of when we can buy those 4% tax-frees that we've been talking so much about over the videos these last couple of weeks.
That's the target, right?
That's the target.
Okay, equity-wise, as I mentioned, ugly week, ugly day. Let's take a step back and look at a couple of charts. The first one is the S&P 500. These are point and figure charts. It doesn't really matter what type of charting system you like to use. I like point and figure because it's very clean. And what you notice in the S&P is we've gotten right back down to where we've been 4 weeks ago and prior. This is a sticky area. And if you were looking at this chart by itself, you would say, this is a buyable scenario. But one thing that I've found is the more times you test an area, the more likely you are to break through it. And that can be on the downside or the upside. So that area has been an area of demand coming into the market. We'll see next week if it continues to be. Wouldn't be completely surprised to see the S&P break that and then rally. We've seen that often where so many stops. We're not the only people looking at this. This is clear as a bell. So many stops are sitting below this support area. And I don't say support line or support number. It's an area of support. That when you get a break through that support and trigger those sells, you can really wipe out some of the selling and rally. That normally is a short-term rally, but we'll get to that in the future. Let's take a look at small cap, IJR. Again, ugly day, ugly week, but a little bit more attractive chart. And why do I say that? Last time up made a high and haven't pulled back as far towards the previous support. And small caps have acted a bit better than large caps. Keep in mind, when we're looking at filters, value continues to outperform growth. Important for us to keep a barbelled approach in our strategies. This week, only trade we did was in tactical trend on the equity side. We added to our pharmaceutical position. PPH pulled back to where we initiated that position a couple of weeks ago. Cash flow, cash hogs. Those are the types of names you normally want to be buying in an inflationary environment because you battle inflation with cash flow. Now, I'll give you the funny thing, Shaun. It's not working because the cash hogs are going down with everything else. That will tend to right itself, but important to follow the cash flow in the equity market, because if you have negative cash flow and you're facing higher rates, it's obviously more expensive to raise capital to grow. So important for us to be aware of where we sit in these two charts. Important to see how the market treats these areas next week. And then from there, we'll get back into certain sectors and industries. So next week, I'm sure will be on par with this week in terms of interesting.
I can't imagine it gets much worse. So
if there's one thing, I can't find anyone who thinks this market's going higher. If there's one thing from a sentiment standpoint,
they're alone in that boat.
The sentiment's sour. Sometimes that can be helpful from where money is currently positioned. But price is king. We'll go from there. Enjoy the weekend. Belmont Stakes. Don't forget to like, comment, and subscribe. We'll see you next week.